It's essential to strike a balance between keeping some cash for immediate needs and potential emergencies while also considering other investment options to preserve and grow your wealth. Investing in assets that can potentially outperform cash while offering a level of safety requires careful consideration and risk assessment. Here are 3 assets that are often considered better and safer than keeping your money in cash. Welcome to Trillionaire Self. Let's go deeper into the 3 assets that are better and safer than cash. Asset number 1, stock market investments. Stock market investments refer to the buying and selling of ownership shares in publicly traded companies through organized exchanges or over-the-counter markets. When you invest in the stock market, you are essentially becoming a partial owner, shareholder, of the company whose stock you purchase. As a shareholder, you have the potential to benefit from the company's growth and profitability. So under stock market investments, let's talk about publicly traded companies, stock exchanges, stock symbols, stock price, buying stocks, selling stocks, dividends and capital gains, risk and volatility, and long-term perspective. Publicly traded companies. Stock market investments involve buying and selling shares of publicly traded companies. These are companies that have listed their shares on stock exchanges, making them available for public investors to trade. Stock exchanges. Stock exchanges are centralized marketplaces where buyers and sellers come together to trade stocks. Some of the well-known stock exchanges include the New York Stock Exchange, NYSE, and the NASDAQ in the United States, the London Stock Exchange, LSE, in the UK, and the Tokyo Stock Exchange, TSE, in Japan, among others. Stock symbols. Each publicly traded company is assigned a unique stock symbol, ticker symbol, that represents its shares on the exchange. For example, Apple Inc. has the stock symbol ADAPL, stock price. The stock price represents the current market value of one share of a company's stock. It fluctuates based on supply and demand factors, company performance, economic conditions, and investor sentiment. Buying stocks. To invest in the stock market, you need to open a brokerage account with a financial institution or an online brokerage platform. You can place buy orders for specific stocks, indicating the number of shares you wish to purchase and the price you're willing to pay. Once your order is executed, you become a shareholder in that company. Selling stocks. Similarly, you can sell your shares in a company by placing a sell order through your brokerage account. The proceeds from the sale will be deposited into your account. Dividends and capital gains. As a shareholder, you may be entitled to receive dividends, which are a portion of the company's profits distributed to shareholders. Additionally, if the stock price increases from the time you bought it to the time you sell it, you can make a profit known as a capital gain. Risk and volatility. Investing in the stock market involves risk. The value of stocks can fluctuate significantly over time, and individual companies can face challenges or even go bankrupt. Diversification, which means spreading your investments across different companies and industries, can help reduce risk. Long-term perspective. The stock market is known to have its ups and downs in the short term, but historically, it has provided solid returns over the long term. Many investors adopt a long-term perspective and hold on to their investments for years or even decades. Remember that stock market investments should align with your financial goals, risk tolerance, and investment time horizon. Before investing, it's crucial to do your research or seek advice from a financial advisor to make informed decisions and build a well-balanced portfolio. Asset number 2, bonds. Bonds are debt securities issued by governments, municipalities, or corporations to raise capital from investors. When you invest in a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of the principal amount at a specified maturity date. Bonds are considered fixed income investments because they offer a predetermined stream of income in the form of interest. Deep inside bonds, let me explain all about issuer, face value, coupon rate, interest payments, maturity date, market price, yield, and credit rating. Issuer. The issuer of a bond is the entity or organization that borrows money by issuing the bond. It can be a national government, such as U.S. Treasury bonds, a local government or municipality, municipal bonds, or a corporation, corporate bonds. Each bond represents a contractual agreement between the issuer and the investor. Face value. The face value, also known as the par value or principal, is the initial amount of money the bondholder will receive when the bond matures. It's typically set at $1,000 or a multiple thereof for most bonds. Coupon rate. The coupon rate is the fixed interest rate that the bond will pay the investor annually, or semi-annually or quarterly, depending on the bond's terms. For example, if the bond has a face value of $1,000 and a coupon rate of 5%, the bondholder will receive $50 in interest payments each year. Interest payments. Bondholders receive regular interest payments, typically known as coupon payments, based on the coupon rate and the face value of the bond. These payments are usually fixed over the life of the bond. Maturity date. The maturity date is the point in time when the bond reaches its full term, and the issuer is obligated to repay the bondholder the face value of the bond. Bonds can have various maturity periods, ranging from a few months to several decades. Market price. The market price of a bond can fluctuate over time due to changes in interest rates, credit ratings, and investor demand. If the bond's market price is higher than the face value, it is said to be trading at a premium. Conversely, if the market price is lower than the face value, it is trading at a discount. Yield. The yield of a bond represents the annualized return an investor can expect to receive based on the bond's current market price and coupon rate. If the bond is trading at a premium, the yield will be lower than the coupon rate, and if it's trading at a discount, the yield will be higher than the coupon rate. Credit rating. Bonds issued by corporations and governments are assigned credit ratings by credit rating agencies. These ratings assess the issuer's creditworthiness and the likelihood of defaulting on bond payments. Higher-rated bonds are considered safer but may offer lower yields, while lower-rated bonds carry higher risk but may offer higher yields. Bonds are generally considered less risky than stocks because they offer fixed interest payments and the return of the principal at maturity. They are often favored by investors seeking steady income and a more predictable investment compared to the potentially higher volatility of the stock market. However, it's essential to consider factors like interest rate risk, inflation risk, and credit risk when investing in bonds, as they can affect the bond's performance and value. As with any investment, diversification and understanding your risk tolerance are crucial when including bonds in your investment portfolio. Asset number 3, real estate. Real estate refers to property consisting of land and any physical structures or improvements built on it. It encompasses residential properties, houses, apartments, condos, commercial properties, office buildings, retail spaces, industrial properties, warehouses, factories, and land for agricultural or development purposes. Real estate is a tangible asset, meaning it has a physical presence and can be touched and seen. Inside the real estate asset, let me break down residential real estate, commercial real estate, industrial real estate, land, investment potential, leverage, market factors, risks, and real estate investment trusts, REITs. Residential real estate. This type of real estate is used for housing purposes. It includes single-family homes, townhouses, condominiums, and apartment buildings. Residential real estate is primarily purchased and used for personal occupancy, but some investors buy residential properties for rental income or potential capital appreciation. Commercial real estate. Commercial real estate refers to properties used for business or commercial purposes. This category includes office buildings, retail spaces, shopping malls, hotels, restaurants, and warehouses. Commercial real estate is often leased or rented to businesses for their operations. Industrial real estate. Industrial real estate includes properties used for manufacturing, production, storage, and distribution of goods. Warehouses, factories, distribution centers, and industrial parks are examples of industrial real estate. Investors in this sector may focus on leasing space to companies or industries requiring such facilities. Land. Land without any structures or improvements is also considered real estate. Investors may purchase land for various purposes such as agricultural use, future development, or land banking, holding on to undeveloped land for potential future appreciation. Investment potential. Real estate can be an attractive investment due to its potential for generating rental income and capital appreciation. Rental properties can provide a steady cash flow, especially when demand for rental housing is strong. Additionally, real estate values have historically appreciated over the long term, allowing investors to build equity and wealth. Leverage. Real estate can be purchased using borrowed money, mortgages, which allows investors to use leverage. Leveraging can amplify returns when property values rise, but it also increases risk if property values decline. Market factors. The real estate market is influenced by various factors, including supply and demand dynamics, interest rates, economic conditions, and population growth. Local factors, such as job opportunities and infrastructure development, also play a significant role in determining real estate values. Risks. Real estate investing comes with risks, including property maintenance costs, potential vacancies, changes in property values, and the overall economic health of the region. Moreover, liquidity can be a challenge as real estate is not as easily traded as stocks or bonds. Real estate investment trusts, REITs. For individuals who want exposure to real estate without owning physical properties, REITs offer an alternative. REITs are companies that own, operate, or finance income-producing real estate. By investing in REITs, individuals can gain exposure to the real estate market and earn dividends without the direct responsibility of property management. Real estate can be a lucrative and diversified addition to an investment portfolio, but it requires careful research, understanding of local markets, and consideration of individual financial goals and risk tolerance. Working with real estate agents, property managers, or real estate investment advisors can be beneficial for those looking to invest in this asset class. Did you enjoy to know that you don't have to keep your money in the bank? Don't forget to like this video, share it, and subscribe for more.